You might qualify for a mortgage and then lose the rate because a different credit score pulled by your lender changed everything. Sound unfair? On the 6th of January 2026, the FHFA ramped up pressure on the whole credit score ecosystem. And that move could change who can sell you a mortgage, how scores get licensed, and whether your file is judged with classic FICO, FICO 10 tons, VantageScore 4, or something else entirely. Stay with me. Over the next 12 minutes, you'll learn exactly what the FHFA said and didn't say, why the credit bureaus scrambled, how FICO and VantageScore reacted, and a precise 30 and 90-day plan you can use if you're shopping for a mortgage right now. Here's the quick promise. By the end of this narration, you'll know which score might get pulled on your mortgage, how that can change your mortgage approval or rate, and a concrete step-by-step checklist to reduce the chance of a nasty surprise during underwriting. This is educational only, not legal, tax, or financial advice, and the facts here are drawn from FHFA announcements, Fannie Mae and Freddie Mac disclosures, VantageScore press releases, and reporting current as of the 9th of January 2026. Always double check with your lender before you apply. What happened? In July 2025, the FHFA formally authorized the use of VantageScore 4 for mortgages that will be sold to Fannie Mae and Freddie Mac, which implemented competition requirements in the Credit Score Competition Act. Then around the 6th of January 2026, the FHFA intensified scrutiny and rulemaking in a way critics said could limit how scoring models tied to consumer data providers are used. The net effect is that lenders now have an approved viable alternative to classic FICO, but the regulatory language and enforcement posture created real uncertainty about which licensing pathways will remain open. Some media outlets reported proposed FHFA language that would effectively bar models developed by entities affiliated with the national credit bureaus. If that language had stayed in the final rule, it could have excluded VantageScore, which is backed by the 3 national consumer reporting agencies, from enterprise eligibility. Follow-up reporting shows the final language was amended and the most explicit blacklist phrasing was removed or softened. So what looked like a ban briefly became a complicated negotiation between regulators, scoring companies, and lenders. The traditional plumbing of mortgage credit scoring flows through the 3 national credit reporting agencies, Experian, Equifax, and TransUnion, which package reports and usually supply scores like classic FICO to mortgage lenders. VantageScore 4 is structured differently. It's a model developed by a joint venture and was expressly approved for use by the enterprises. The proposed FHFA independence provisions, if interpreted strictly, would limit models where the vendor's ownership or data links create potential conflicts of interest with consumer reporting. Why does that matter to you? Because it could force lenders to get scores through alternative channels, for example buying VantageScore from a third-party vendor, or getting FICO scores directly from Fair Isaac instead of bundled bureau packages. That scramble for new distribution routes is exactly why pricing and contracts started changing across 2025 and into early 2026. If your lender suddenly has to buy scores a different way, who pays? Do those fees get passed on to you, or do some lenders simply stop offering certain loan products? These are practical questions that affect rates, product availability, and underwriting timelines. When FHFA opened the door to VantageScore 4, the market moved fast. FICO explored delivering scores directly to lenders, bypassing bureau intermediaries, while the national consumer reporting agencies adjusted pricing and distribution strategies. Equifax and others ran promotional pricing, bundling, or discount offers to keep lenders buying scores the old way. Investors noticed. FICO's stock dipped after the July 2025 announcement, while VantageScore and the bureaus drew attention and coverage across financial press. Vendors don't only compete on accuracy, they compete on distribution control. FICO pushing direct-to-lender delivery is a strategic attempt to keep Fair Isaac in the underwriting loop even if bureau channels become politically constrained. The bureau's promotional pricing is an attempt to preserve lock-in with lenders. Which approach is better for consumers, more competition on models, or more control for lenders? The truth is, both matter, but the immediate winner or loser will be determined by contract and pricing, not theory. The FHFA and the enterprises said implementation would be phased, with industry adoption taking roughly 18 to 24 months after an approval decision. Fannie Mae published specific disclosure changes effective the 17th of November 2025 to add new VantageScore fields and rename classic FICO fields in investor disclosure files. In plain terms, mortgage pipelines over late 2025 and early 2026 are a mix. Some lenders pull classic FICO, some test VantageScore 4, and others pull both. Timing matters. If you lock a rate in a pipeline where the lender later switches scoring vendors, you could face a mid-process underwriting reevaluation under a different model. That's the practical risk investors and lenders are watching and why consumer action matters. Don't assume the score you see on a free credit app is the one the lender will use. Ask, confirm in writing, and recheck. Let's get concrete about model differences. VantageScore 4 and Classic FICO can produce materially different outcomes for people with thin files or lots of alternative credit like rent, utilities, or cell phone payments. In some cases, VantageScore 4 pulls alternative signals that can raise a qualifying score. In others, differences in the model's treatment of recent delinquencies or utilization can lower it. Someone with limited traditional credit but a perfect rent history might see a higher VantageScore 4 than Classic FICO. Conversely, a borrower with long established trade lines and high utilization might see VantageScore 4 score a bit lower. The bottom line is score differences are real, and they can change whether you get the loan or what your interest rate looks like. Vendors are already changing contracts and delivery models. FICO pushes direct delivery and new score products to stay relevant if bureau distribution is constrained. The consumer reporting agencies compete on pricing, discounts, and bundling to remain the default channel. VantageScore highlights broader access and potential to expand credit to more borrowers. Public stories document price and distribution negotiations, but exact contract terms between lenders and vendors vary. Different lenders will see different costs and different score sources. A practical implication: lenders that depend on low-cost bundled bureau services may temporarily shrink the number of loan products they offer if costs spike. Fewer loan options could mean higher rates or stricter approval requirements for some borrowers. With that in mind, here is a focused action plan you can use in the next 30 and 90 days if you're shopping for a mortgage or worried about score volatility. Immediate 30-day actions. Ask your lender in writing which score, model, and vendor they will use for underwriting and for the automated underwriting system run. If the lender will not answer, consider working with a mortgage broker who will. Pull both Classic FICO and VantageScore 4 estimates if available using paid products or authorized vendor tools that show the models lenders might use. Document rent and utility payments now. Get year-to-date statements or enroll in a rent reporting service if you have a thin file. If you see errors on your credit reports, file disputes immediately and pay attention to verification windows. Time matters in mortgage pipelines. 90-day actions as you approach lock and closing. Recheck the underwriting score 7 to 10 days before rate lock, and again before clear to close, and ask for confirmation from the lender about which model is being used at each stage. If you have mismatched scores and one model jeopardizes your rate or eligibility, ask whether the lender can run both models and choose the more favorable outcome. Some lenders will if automated underwriting or investor rules permit it. Prepare targeted dispute scripts. Keep your requests factual, cite account numbers, request verification documentation, and escalate to a supervisor or the Consumer Financial Protection Bureau if you hit dead ends. If your file is thin, prioritize adding trade lines quickly, for example, by becoming an authorized user, opening a small secured card, or using rent and utility reporting services.